Okay, well, thanks so much to everyone who's able to make it for their lunch break. The Wharton Executive MBA program is truly excited to have this discussion on federal tax reform. Before we get started, I know some folks are still, finding their seats, so just wanted to introduce the folks who are visiting with us today. First, we have Kathy Koch, America's tax policy leader at EY. She was former chief policy advisor for tax and economics to the former Senate Majority Leader, Harry Reid. And she was also the former tax chief for the Senate Finance Committee. So we're all really excited to have her with us today. And we also have Professor Kent Smetters, faculty director of the Penn Wharton budget model. He's the Bettner Professor in the Department of Business Economics and Public Policy at the Wharton School of the University of Pennsylvania, research fellow at the National Bureau of Economic Research, and previously he was the Deputy Assistant Secretary for Economic Policy at the U.S. Department of the Treasury. And I'm Sunny Han. I'm a state tax counsel and assistant vice president at MassMutual. So we have a pretty lively agenda set up today. So in order to make the best use of everyone's time, we've decided to divide up today's tax discussion into 3 segments. The first will be on public policy. The second is going to be on macro level effects. And then lastly, on tax planning considerations from a technical perspective. So Kathy, would you like to start us off?
Sure, I'll start off. I'm going to talk a lot about the policy and the process and some of the politics. And we're generally, I think, holding questions to the end. But if you really want to know something, I like to be conversational. So we can take burning questions, certainly. The whole tax reform that was passed pretty much in the blink of an eye represents a major, major change in how we're all taxed. And not so much us as individuals, we have a little change, but how corporations, businesses, employers pass through, it's pretty striking. So I want to talk a little bit about the drivers of reform and the politics and framing, and then we can get into kind of what is actually in the bill. The tax reform bill in my most...
Do you want to use the clicker or no? It's up to you.
Let's see. Yeah. Not yet.
All right.
That's the punchline.
All right.
But thank you. No, so I think this tax reform bill at its heart, and first of all, these are only my thoughts. I don't represent EY in my statements. But I believe pretty sincerely that this tax reform bill at its heart was a corporate rate reduction and a move to territorial. That was the heart of this bill. Then I think they kind of wrapped it up in a middle-class tax cut and took off. But why was it so important to do a corporate tax reform? The major drivers of this bill were the high US statutory rate and our worldwide system of taxation. Because of those two factors, US companies felt increasingly unable to compete in foreign jurisdictions. So I used to work for GE. Does anybody here work for GE? I had a friend who was in this program before from GE. So GE would work in Singapore, produce things in Singapore. Siemens would produce things in Singapore. And the tax impacts on both were very, very different because GE was subject to a worldwide system of tax in the US. That is, whenever they brought those profits home from Singapore, they'd have to pay some US tax on it. Siemens come from Germany, doesn't have a worldwide system, has a territorial system, so they're only paying local level tax. And one of the big arguments that we used to make was, well, after earning money in these third-party jurisdictions, Siemens can bring $100 into the US and invest it all. GE can only bring $100 in and only invest 70. And, I could argue that the 30 paid in tax was an investment, but most would argue that it wasn't. So this was a major driver of tax reform. Our statutory rate was the highest amongst industrialized countries by the time this tax reform came along. We were at 36%, and every other, I'll show you this, I'll show it to you later, but we're the yellow line, I think enough said, right? This was our rate relative to everyone else's. So not only did we subject our companies to tax on every penny they made all over the world, but we taxed it at a higher rate. Yep. So this was what drove tax reform. And I think the real trick that we saw with respect to this tax reform was kind of how do they sell this essentially corporate tax bill to people, to voters? Because this situation existed for a really long time. I mean, 86 tax reform, we kind of started fresh in some sense, but since 86 we haven't seen any real changes, and this situation was building up for this past 30 years. But what happened this time that I feel was really different was they were able to kind of take it to the streets. They were able to take the corporate reform and sell it to the middle class. Because remember, after this election, which was one of the most populist elections, at least in my lifetime, there was a pretty good trick to pass a bill that was mostly a corporate rate reduction. And they did it by selling it to the middle class, by talking about jobs, by talking about increased wages that would happen from the corporate rate reduction. And then they threw in some small business stuff there too, because small business is one of the most powerful political constituencies in this system.
Kathy, quick high-level question. So tax is obviously a very technical subject. In order to get U.S. citizens so educated, how long do you think this process was in order for them to get?
Well, interestingly, I think this, Dave Camp started talking about tax reform in 2011. Okay, so that's about 6.5 years before it really started. The Camp bill was released, Mr. Camp and then Mr. Baucus, bipartisan, bicameral product, which is important to keep in mind. That was released in 2014. So then we're talking about kind of more, is that 4.5 years? But really, the rubber hit the road in September of 2017. So you had like 30 years of nothing, 6.5 years after really kind of talking about it seriously, 4.5 years after seeing a draft that was legit, and 12 weeks it was passed. So that shows you, the buildup was big, but when things got moving, it had to be done quickly. Otherwise, the politics would have killed it. That's the speed of this process was both, I say, and I say this to my Mitch McConnell friends, its biggest sin and the most critical component of its success was the speed of the process. Yeah, it was, but they did it by saying, okay, you're going to get a wage cut or a wage increase, and you're going to get a new job, and your grandmother her 401k plan is going to go all, this is all good for everyone. This isn't about corporations. This is not about CEOs. This is about you guys. It's also about that disenfranchised group that brought Trump into office, right? These people out there that lost their jobs through economic change, and we have economic change all the time, and industries that die aren't the ones, people that work in those industries aren't the ones that get jobs in new industries. But we tried for years in Congress to extend trade adjustment assistance, to extend, unemployment, and we couldn't because it was so expensive. But that constituency finally had enough. And this political process was able to tie the benefits of this bill to those people. Now, I want Ken, he's going to tell us later, was that a real sell? Was that true? I mean, we all know that, corporations don't pay taxes. People pay taxes, but how much of those taxes were borne by actual workers? So how much of these kind of tax reform dividends that you hear announced, Walmart's giving a raise, all these, how much of that is real, how much of that is lasting, and how much of that is kind of a direct result of this tax reform, I think is going to be a politically important thing, not in November, but maybe some November in the future. And we talked about timeline, and I don't know if anybody kind of was mystified by how the heck did that happen? It's like, were you reading the paper one day and then you read it the next day and thought, oh my God, it's law? Did anyone feel that way?
So, I know I did.
And so normally, a process, regular order. Anybody familiar with, how a bill becomes a law? I'm not going to do the Schoolhouse Rock for you. However, right, this Schoolhouse Rock did not apply in this case. Now, so normally, right, a bill gets heard in a committee, Senate Finance Committee, House Ways and Means Committee. You do hearings, then you get a bill together, and all the time you're selling it and selling it and selling it to your constituents in broader and broader and broader circles as you add and subtract things. Then you have what's called a markup. You sit in a room like this, actually, and senators or congressmen decide what they like, what they don't like, and you come out with a product. That product goes to the floor of either chamber. There's amendments in those floor proceedings. Then they come out, they have a conference, everybody takes two bills and makes them the same, goes to the president, whose people have been at the table the whole time. This was not that. This was a bill that went through a process called budget reconciliation. And budget reconciliation is interesting only because you'll probably hear it again over the next X years. Budget reconciliation was a process that was initially designed to help raise taxes. Robert C. Byrd wanted a system that could help us raise taxes, and since nobody really wanted to raise taxes, it was very difficult to get a supermajority approval in the Senate. The Senate always has to have a supermajority. And that's for a reason. That's because the Senate is designed to uphold the rules, the views of the minority. But it was impossible to pass tax increases to reduce the deficit. So they started reconciliation. The quid pro quo for reconciliation, which allows a bill to be passed with a simple majority in the Senate, is that you cannot increase the deficit outside the budget window. So this big fat tax cut had to not lose any money after 10 years. And also every provision had to, affect deficits. It couldn't just be a policy in there. So because this Senate only had a 2-seat majority for Republicans, and Republicans absolutely positively needed to pass this tax bill because this was the only thing that really passed this year, if we recall, right? The failure of healthcare may be the second most important driver in this tax reform bill because it became such a political imperative to get it done. We only have a 2-seat majority, so they decided, let's use reconciliation to get this done. The last 5 presidents, by the way, 3 of them have used budget reconciliation to pass tax decreases. So this was not this is not an abuse of the rule. It's a common use of the process. So Republicans realized Dems aren't going to work with them, or they're really not interested in taking the time because they want it done right away. They decided to go budget reconciliation, and that means that there was all kinds of things in the bill that are designed to adhere to the rules. It also means they had to be quick because budget reconciliation, you pass it in the budget, the instruction comes out of a committee, okay, you got to design a bill that meets all these rules and get it through. These tend to be highly political bills. They tend to be easy to attack. Opposition research is just ready, right? Because the part of this cutout has nothing to do but sit around and look up reasons why this bill is bad. So it had to go super, super fast, and that's what happened. The bill went through, again, from the first, the unified budget was September 2017. The bill was signed into law December 22nd. Yep. There's a couple interesting things in the bill that reflect reconciliation. Number 1, all the individual provisions, all your rate cuts expire after 2025. The corporate rate cuts don't expire. That, to me, was almost a breathtaking political feat. Just imagine, right, the sale to the American people that we know, you guys are disenfranchised. You guys need a tax cut, but by the way, yours goes away. It just shows the momentum that was behind this thing once it started. It was unstoppable. It was absolutely unstoppable. And then
That's a great point that you raised, Kathy, because I think in the media there's a lot of discussion, these tax rates, they could be further extended. They would not necessarily sunset. But as you point out, the corporate rates, they didn't go to the trouble. It's a flat rate cut.
They didn't go to the trouble. And I think it would be a hard sell to say, okay, this corporate rate cut is going to attract all kinds of foreign direct investment, if it's temporary, but still the political tarnish on this was amazing. There was 2 big issues that this bill overcame politically that, kind of are stunning, and I think it's due to the speed of the process. One of them is the distributional impact. Who really got the benefits of this bill? The Joint Committee, where I used to work, Joint Committee on Taxation, does all the technical tax writing work for Congress. They're a nonpartisan committee. They score it, they draft, they help draft it, they analyze it. But they put out a distribution table. Now Kent can talk a lot about that. It's interesting, though, because it did show, everyone got a tax break. Now, the size of the tax break, generally speaking, as you go up the income distribution, the tax breaks are bigger. Now, that makes sense because, I think 20% of the people pay 60% of the taxes. However, it was something that just didn't have any traction in the press. So distribution should have been a big deal. Also, when the tax rates expire, the distribution tables show that these, obviously when the tax rates expire, the distribution tables pop back to a pretty nasty looking distribution. Right, the distribution was a huge issue going into it, turned out not to be that much of a roadblock. The other was the macro impact, which Kent knows all about. Did this bill pay for itself? You remember that was all the rhetoric. We're doing a $1.5 trillion tax cut, and it was going to pay for itself and increase economic activity. Now, by the end, I mean, not even the conservative think tanks put out studies that said it would pay for itself. And in the end, the administration kind of veered and said, well, we don't mean just the tax cuts, we mean the entire agenda. The regulatory agenda is actually very impactful when it comes to economic activity in this country. But those two things, they just didn't kind of slow down the process, which, again, I think more time, more baking out in the sun, they would have really hurt the chances to get done. But it moved so fast that those two issues largely passed by unnoticed. And then there was the pass-throughs, right? You know, the small business community, once you got the small business community behind it by making a 20% deduction from taxable income at 21% top rate for pass-throughs, that was a real sweetener. And at the end, that was one of the last things that helped it pass the Senate, was that provision.
I want to take a quick pause here. I just, for the pass-through entity, that rule for folks who are not familiar with the difference, I mean, obviously you have this huge corporate rate cut that brings you down from 35 to 21%. But on the pass-through entity side, as you know, that income is flow-through. So with a minority of jurisdictions where those entities are taxed at the state level, for federal tax purposes, you're effectively being taxed on pass-through entity income, that is an LLC, partnership, S-corp, that sort of thing, at the individual tax rate, which is, per the new federal tax law, high max rate of 37%. So there, you know, as Kathy already pointed out, there's a lot of speed with which the tax bill was passed, but Congress did implement small deduction for what is called qualified business income to the tune of 20% of the income earned by that pass-through entity. And we'll talk about that a little bit later, but it is actually a pretty key feature of tax reform. So
it's a very key feature because when we talk about small business, when you read about small business in kind of the tax press, they mean pass-through. They actually don't mean small business. And those can be two very, very different things. But politically, this is what carries it over. You know, because everyone thinks of, you know, kind of the gas station guy. Or when I did healthcare, so I was involved in the ACA, which was also a reconciliation bill. And one of our big things for the net investment income tax, which is tax levied on your investment income over $250,000 of wage income, you know, everyone was so worried that we were going to, because it was on pass-through income. Oh my God. And I can't even tell you who in the, great, this is the Roosevelt room, you know, like, could my gas station attendant be subject to that? Because if so, we're going to pull pass-throughs out. In fact, if you look at the net investment income tax, pass-throughs are not, income, investments in pass-throughs are not subject to that tax. And it all has to do with this kind of illusion that that's small business income. And even when you tell someone, well, it's actually not so small, the bad newspaper story from one stray small businessman who got clipped by that tax was just too dangerous politically. So the whole thing is a study in messaging. This was a brilliant messaging. I guess that shouldn't surprise us. We have an administration that's very good at messaging. So I want to talk about, I'm just going to really quickly show you snapshots of what's in this bill. And they're pretty easy, right? Everybody got a rate reduction on their marginal rate. Interestingly, these the way you creep up the brackets, the way they grow the bracket cutoffs has changed, and it's slowed down a lot, so that's kind of like a little bit of a stealth tax in there that you're not going to know about. But everyone got a big rate reduction, and the standard deduction doubled. Who here itemizes? Oh, good for you guys. So nicely done. But that's too bad because, anyway, the standard deduction doubling was one of the big selling points. Now, the other thing that is that, so I have 4 kids. I lost my personal exemptions for all my kids. The standard deduction doubling doesn't really help me out. You don't get a child credit. So this wasn't me. But this was kind of, I would say these are the headlines of the individual system, was the standard deduction doubling, lower rates, right? And then a new child care credit that kind of took the place of your personal exemption.
And a lot of the folks here, being from the Philadelphia campus, are on the East Coast, so state and local tax deduction being repealed was huge.
Yeah, that is, thank you. That's one of the, as we were talking before, You know, we talk about tax reform being kind of simplification. This was not a simplification bill. You know, simplification, first of all, is one of the most overrated policy goals, I think, in the world, because nobody really cares if they're paying more taxes. They don't care if it's on a postcard. If I'm paying more taxes, I don't want it. Simplification, one of the largest base broadeners for individuals was the elimination of the state and local tax deduction. I grew up around here, so I'm mad with you. I live in Virginia now, so I'm a little better off than my colleagues in DC and Maryland. On business, the business, again, the heart of this bill is the 21% corporate rate. A very interesting policy discussion we had was limitation of the deductibility of interest. You know, interest was always fully deductible, dividends weren't. It made a big difference on how companies financed operations or finance investments. So that was a huge deal. This is very much like what we're seeing in Europe with the base erosion and profit shifting, you know, effort to end double non-taxation, which is kind of a sexy term, but we can talk about that later. But those are the biggies on the business. And then the international, this is the part of the system that was probably the grease that got it through, because this part of the bill increased taxes on the overseas operations of US multinationals by $300 billion or so. And this was how we said, look, we can go to territorial or a quasi-territorial system, which you can talk about because it's not truly territorial, but so we have a dividend exemption system. So instead of the money being earned overseas not being subject to tax, it's just when they pay up to their parent corp in a dividend, those dividends are totally tax-free. But it's not as if the money earned is not subject to tax. So there's that. There's a transition tax. Everybody here, repatriation, mandatory repat. It's not a mandatory repat. It's a deemed repatriation. We can talk about that later if you like. And then they have all these base erosion taxes, a GILTI tax, global, you know, low tax, global intangible low tax income tax, FDII, which is, you know, it's kind of like a patent box. And then finally, the BEAT, the base erosion anti-abuse tax. And all those taxes will hit international income. They're very complicated. We can talk about that, you know, later. But that, you know, that pretty much sums it up. The tax bill in total lowered taxes for individuals by about $1 trillion, lowered taxes for corporations by about $6, and then increased taxes on international operations by about $300 billion. Yeah. So it was a pretty, you know, it wasn't, I would say that if you put this system up for grabs now, I think Democrats would have taken 80% of this, and they'll tell you that now. It was just, no one could afford to tangle with them time-wise on the other 20%. Yep. But it was the macro impact and the distributional impact that surprised me the most, because that's where Democrats are trying to, you know, vilify this tax, and that's what you know all about, Ken.
All right.
Ken,
Great.
did you want
Yeah.
I'm sorry.
Thank you. No, I think that was a great setup.
Thank you.
And so let me give you some results of the model simulations that we ran for the tax package. And the Penn Wharton budget model and one other group were the only two groups that are doing independent scoring, both on a static and dynamic basis of the tax bill. And most of our work was actually not posted on our website. We're doing it directly for members of Congress. And so in Washington, we make a big deal about what we call the conventional score, sometimes called the static score. This is the score that is typically done where it doesn't include any economic feedback effects. So for example, if you think a reduction in tax rates will grow the economy, that will mean that you'll have a bigger tax base, and any particular rates will give you more revenue. Traditionally, the static score is how it's done with no economic feedback effects. There's a House rule that basically says for taxes in particular, there should be a dynamic score as well. I'll show you that. It's a little lopsided of a discussion because they don't want dynamic scores for, you know, things like early childhood education and things like that. They want it on the tax side alone. And so let me just give you the kind of the top line numbers, and that is on the individual side. So Joint Committee on Taxation, they're the official scores of the government. We basically said that you're going to lose about $1.2 trillion over 10 years. That's also a traditional budget window. On the individual tax side, the JCT and us were pretty similar on that. They're the official guys. We got there very differently. The alternative minimum tax is a very different cost in our model versus their model, but nonetheless, in aggregate, we've kind of sum up to about the same. And then on the corporate side, that's where we have the biggest disagreement on. We say this is going to lose more money than what the Joint Committee on Taxation says. And one reason why we took a more pessimistic view is Richard Provenzano here, who works with us. He was the leading guardrail pass-through guy at Treasury for many years, and he just joined us this last summer. And that is, our view is that the guardrails in the tax bill for things like base erosion, income shifting, income reclassification, there's so many opportunities in this bill to reclassify your income. I mean, my joke is that, you know, I should become an independent contractor for Penn, and just because, you know, that there's, you know, set up my own S corp is going to be, and maybe sell some of my services, especially as software services that I provide, and maybe grow some tomatoes. I'll be a farmer too. But in any case, there's so many different opportunities for income reclassification that's going to erode the tax base. And so we incorporate all those changes. And then on the international side, that's where you get some revenue from this deemed repatriation and some other features. We are much similar to JCT on that, not as optimistic, but is still a little bit more cautious on that. If anything, so altogether, us and JCT on a debt service basis, I'll show you that in just a little bit, we differ by almost by $500 billion over the 10-year basis. We are very similar on the Senate version of the plan, very different on the final version of the plan, and it's simply because of a lot of these base erosion, the guardrails that we think are actually too weak, and some other things that are kind of going on. By the way, this outlay stuff is kind of a weird nomenclature in Washington. This part of the Affordable Care Act was brought into this. That's actually considered an outlay, not a revenue. So we do it kind of both ways. But we unlike the JCT, we also go out further in the future. And one reason why we can go out beyond the standard 10-year window is because of our modeling. We actually start with census level data, and we're able to be much more micro in that sense, so we get all the demographic changes that are going on. And so we're able to go out further in time. So this thing's not looking so great over large amounts of time. If you go to the website, we're webcasting this now for those people who are listening there, or alternatively, when you guys go, we'll break it all down by, you can see the slide deck. I'm not going to go through all this, by all the individual stuff where we compare us versus JCT on both the individual, the corporate, and the international side. We also did analysis on the industry level. And I think this stuff is kind of interesting. And in particular, different industries are hit very differently. But let me show you kind of all industries to begin with. So the statutory tax rate is 35% in the United States. The effective tax rate is actually much less than that, because there's all different ways of reducing your tax bill. And so what economists refer to as the effective tax rate, we calculated, and there's some debate how you handle state and local taxes, because it's not a perfect value-added tax system at the state and local, some debate about that. But at least on the federal side, we calculate a pre-reform tax rate of about 21%. So that 35% comes down to about 21%. And then after the tax bill, the effective tax rate drops to a little more than 9%. And what's interesting about that, that's what you'd expect, is that if you look at that effective tax rate, it actually creeps up over time. So there's a little jump on some years here. And so what's going on there? One reason why the effective tax rate is actually below the statutory rate, there's many reasons, but one of the reasons is known as bonus depreciation, or depreciation beyond the speed of economic depreciation. And so that's actually already in current law. You depreciate your assets. So a part of this bill goes to what's called full expensing. When you actually make the investment, you get to write off the entire amount today. By the way, across tax economists, left-right spectrum, we actually tend to agree that expensing is actually a very sensible way to go. You can still maintain your progressivity. It doesn't reward existing capital. It only focuses on new investment. There's pretty broad agreement amongst left-right kind of tax economists. Expensing is the way to go. The problem is it's super expensive. So how you make it cheap is you make it temporary. And in fact, in this bill, normally if you just went to full expensing, you didn't pay for it by dropping the interest deductibility. That's how we typically do it. We'll go full expensing, and we drop interest deductibility, because if you maintain interest deductibility, your effective tax rates are actually negative at that point. And so, but if you just did expensing by itself, it's actually a couple $1 trillion over 10 years. You're not going to be doing that. In the bill, it came out to around $50 billion. How do you do it? Is that you turn it off after 5 years. And what's key about that is that you say, well, still, that's 50%. 5 years, that's 50% of $2 trillion, but it's actually not. It's a tiny number because those assets already would have been depreciated over that 10-year window. Now, Washington, D.C. doesn't understand present value. They do not discount future dollars by anything. So you might say, well, what about that lecture one in my class I tortured you with? That's the way you're supposed to do it. You know, DC doesn't know lecture one. But in any case, so what happens is they just add up undiscounted dollars over the 10-year window. And so what happens is that when you get that full expensing today, it's just shifting the depreciation that you would have gotten in the future to today. And so you pay for it later on by not getting those depreciation allowances later on. That's why that's not the only reason, but that's the main reason why you see the effective tax rate actually creep up back over time. And there's some other things going on as well. And so it's not as juicy as you might think at first blush. And then we also break it down by industry. We could spend a lot of time on this. This got a lot of press as well. Different industries, different effective tax rates, and services industries. You can go on the website and see the services, finance, and real estate. The real estate one, this is all on C Corp level. It's pass-through is a different animal altogether. And then, you know, manufacturing, trade, and so forth. And I'll let you go on the website and see those. Let me get the clicker, and this is also by taxes paid. And now let's talk about dynamics. So dynamics were kind of an interesting one too. Is that both sides of this debate kind of had their, you know, ethical challenges, in my opinion, on how they presented numbers. In particular, those who were in favor of tax reform said this is going to grow the economy immensely and so forth. Under what I would call fairly favorable assumptions of our model setting and so forth, we see that, in fact, the change in GDP by 2027, this is not annualized. I'll show you that in just a little bit. This is basically saying that GDP will be about 0.5% to 1% bigger in 2027 because of this tax bill. And then over time, you can see that as well. You can also see labor income, capital services income. This, by the way, this high return versus low return stuff is about some initial parameterization of the model, some debate amongst tax economists how to do that. We do it both ways. But you can see the range is not that big, not big effects pretty much at all. So we're basically saying by 2027, at the high end, we're talking about 1% increase in GDP. As a result of that, when you think about on an annualized basis, you're talking about an annual increase of between this is in percent, 0.06% and 0.12%. Reason why those numbers are important, there's this heuristic rule of thumb in Washington that basically says that for every 0.1%, 1/10 of 1%, you get a few $250 billion more in revenue. And so all you needed, according to proponents, was a 0.4% increase in the annual rate, and this thing would pay for itself on a dynamic basis because we'd grow the economy and so forth. Two problems. One is that you actually see that this number is a lot less than 0.4%, but the second problem is that 0.4% was actually not the right number anyway, because that was calculated based on the pre-reform tax base. You actually want to calculate on the after reform tax base, which is a smaller tax base. And so the actual number, depending on how you use what's called current policy versus current law, what you expect things that are going to expire under current law if they would have actually been extended, the actual number is about 0.55 to about 0.7, depending if you use what's called current policy or current law. It's another side debate. But obviously our numbers are much smaller in this. It's not going to pay for itself. In fact, if you go out over more time, in fact, the growth rates are even smaller. Now, you say in a dynamic model, you think, it's momentum and so forth. This thing would actually be bigger over the long run. It's not, and it's because of this picture right here. You can ignore cumulative revenues. Just look at the debt impact. What we're saying is that on a static basis, that this program, this tax reform, is going to add about $2.3 trillion in additional debt. If you allow the economy to grow, this dynamic score, it's between 1.9 and $2.2 trillion. This number is about $500 billion more than what the JCT says because, again, we have different views, especially on the guardrail issues. When you have more debt, that is going in the opposite direction of the improvements to the marginal tax rates. We all agree lower tax rates, whether it's through the statutory rate or through increased expensing, which is the one economists tend to prefer, is stimulating for new investment. But when you have new debt that now is competing for that investment, the government's now buying that stuff, that's working in the opposite direction. You can even get what's called negative dynamic scores if you have a lot of giveaways that actually don't stimulate new activity. And so that is where why we get a much more pessimistic number. That's where our pushback against those who had what we call rosy scenarios on the economic side. I will say on the distributional side, the other, what happens is that economists actually generally agree on how to present distributional analysis, so it's called the after-tax, after-transfer income distribution basis. What you actually saw in the press was the top 1% gets this much, the top 10% gets the majority of the tax cut. The top 10% already paid the majority of federal income taxes, including payroll taxes, over 60% of those taxes. It's not surprising, even a proportional change, it looks like it's going to be more rewarding for the top end. So that's not really the right way to look at it. It is more on the after-tax, after-income distribution, after-tax distribution basis. And what was really missing in this debate is that, in fact, not only does the top 10% actually pay most of the taxes in the United States, they're actually scheduled to, before the tax reform, they're actually scheduled to pay even more of that tax base over time because of what's called real bracket creep and other features in the tax law. In many ways, all this did was kind of reset that. And that is by 2040, the top 10% are going to be paying about the same rate share of total taxes as they are today. Yes, there'll be some winners along the way, but let's face it, you can only do tax reform every 30 years. Not surprisingly, you can't map it out year by year kind of basis. And so bottom line is that, we're adding to an enormous amount of debt on top of an enormous amount of debt under the baseline. And that's why, again, as I told you in our class, we want you to work very hard, be very productive, so that we can tax you to death going forward.
Thanks, Ken. Ken is illuminating. So, having heard about the political process as well as the macro level impacts, I think it leaves a few high level questions that all of us in the room are going to have to face regardless of the industry that we're in, right? Tax law was passed very quickly. There are disparate provisions that have a disparate impact on taxpayers. So who are the winners and the losers under the tax bill? I think it's pretty clear based on the information that was provided that depending on the industry, depending on the tax bracket that you are in, frankly, even where you live geographically in the US, it depends. Frankly, I'm still trying to decide in terms of our own company exposure, even as an individual taxpayer, whether or not we will truly benefit under the new tax bill. But I think that there are ways of thinking about the issue that hopefully will be broadly helpful to the folks in this room. Because I think at the end of the day, we want to know how this is going to impact us personally. So first, and this is my own bias as a state tax attorney, there is that federal tax reform and the law change itself, but there are the federal as well as the state and local tax impacts. So when thinking about how this is going to affect you either personally or from a business standpoint, it is good to know where you're located, geographically speaking. So what that means is, are you a multinational company, multi-state company, or are you simply located in one state? And what are the impacts at that level? Another issue to think about is entity selection for folks who are thinking about business endeavors, or we've got quite a few folks who are entrepreneurs in this room. So I imagine that at some point, entity selection is going to become an issue. So, high-level questions. Given the rate reduction, do I want to form a C Corp? Or given some of the benefits that are available to pass-through entities, are we going to consider, depending on the industry that I'm in, forming a disregarded entity in order to take advantage of, quite frankly, some of the sloppy writing in the tax reform or the Tax Cuts and Jobs Act? So there are a couple of highlights. I hesitate to go into the minutia, but a couple of highlights worth considering. We've already talked about this briefly when Kathy mentioned pass-through entities and the opportunities and challenges that are there. Qualified business income and treatment of the same. I think it's been flagged by quite a few service providers and has been reported in the media that to the extent that you're in the real estate industry, there are some real potential benefits. We've got some folks here who are in real estate, so hopefully this will impact them. This is not tax advice. But hypothetically speaking, I mean, there's this I can report on. So QBI, or qualified business income, right now, as I mentioned, you get a 20% deduction on your individual income tax return for what is qualified business income, certain types of income earned by a disregarded entity. So what does that mean, right? Let's say you're in a real estate private equity fund, or you're involved in some kind of endeavor that will, excuse me, will acquire some form of property. This QBI, I should caveat all this by saying, is that there are sufficient wage caps that have made it largely ineffective for tax planning purposes if you are receiving service income or investment income. However, in limited instances, real estate being an example, there's a wage cap which is which will not apply provided that the income earned by the disregarded entity is not investment income, not related to a service, and has some sort of tie to unadjusted basis in properties. That would be pre-depreciation. So there are lots of non-real estate folks in this room, but needless to say, there are some opportunities there. That's one thing to consider. Stepping away from pass-through entities, there's also room in the state tax incentive space. We have not talked about this yet, but there were limitations placed upon the federal rehabilitation tax credit. That was a 10% credit that was previously permitted under the law and no longer exists. It's a common misconception that state and local tax credits correspond or mirror the federal tax provisions. Many of them have the same name and oftentimes piggyback off of the federal grants. But just because a federal tax credit has been repealed does not mean that a state tax credit is going to be repealed. So, depending on whether you're a winner or a loser under the new tax code, it would still behoove just about any company to look and see what state and local tax incentives still remain to either increase your current tax benefit or to mitigate the loss of the taxes that, or of your heightened tax liability under the code. Couple of other thoughts. I know I'm jumping around. I had a chance to speak with some of the folks in this room before the panel, and I'm trying to think of the topics that they found most interesting. But moving away from those two, I think we should talk briefly about international tax. Kathy forecasted the issue and provided a high-level overview already, so I won't belabor the point. But for those who are in multinational companies, or at least primarily U.S. companies with some sort of overseas presence, deemed repatriation is probably one of the largest international tax issues. I would feel bad, frankly, if we left the room and didn't have a high-level sense of what deemed repatriation means and how that could impact your business. Namely, there's a lot of money that's been stored overseas that has not been brought home or repatriated during prior years. This might even have come up in one of our other lectures, I think, in class, right, where certain industries have stored millions of dollars overseas, which are now being brought back, right, under, please.
I was going to say trillions.
Trillions, sorry.
Closing in on
Sorry.
2.6 trillion, and I would guess it's growing overseas.
Yep.
But it's not in cash necessarily, right? It's in
Absolutely.
buildings. Any investment that took advantage of deferral under prior tax law is there. So some of it's buildings, some of it's cash.
Absolutely.
So it's a lot.
Under this new provision, under subpart F, that income is going to be treated as a deemed dividend, which means it does not have to be paid, but it will be subject to tax as if a taxable event had occurred. So to the extent it does exist in the form of cash, it's going to be subject to a 15.5% tax rate. But when you have this non-cash type of income, it's that lower, I believe it's the 8% rate. So,
Both of which are super high relative to any proposal that ever came before it, by the way. Really high rates of tax.
Yep, absolutely. So, and then subsequent to that, we would anticipate some form of actual repatriation, right? Having removed sort of, this opportunity to kind of come forward with all of the accumulated deferred income for prior tax years. So that is going to happen to, I would say, most of the companies that have an overseas presence, and given where our classmates and the companies that they're located, I think a lot of us would be affected. There's also the state tax consideration for how deemed repatriation is going to impact businesses. Depending on the industry, it might or might not have an effect, and that is because everything that we've been talking about in international tax effectively relates to net income taxes. So to the extent that your company is not filing a net income tax return or is filing on the state level, say a gross premium tax return, it's a pretty important distinction because that income is included in a net income base. But if you're not being taxed primarily based upon net income, then that money coming over might not impact you in a lot of key states where you'd have liability. So, happy to talk about that further at a different time, but those are just some of the issues to consider. So
they're big because, that was an immediate accounting hit, right? Which was, so you saw a lot of loss reports because of that, payable over 8 years. But it's funny because in Congress, not only don't we do, we don't discount, but we also, we'll give them 10 years to pay it back. Doesn't matter because it's a day one accounting hit. In fact, this was a fourth quarter event. So the scramble between December 22nd, because he wasn't sure he was going to sign it in the fourth quarter, nobody really knew. So the scramble to do all this estimated tax hit on this fourth quarter event was really bad for most of my colleagues, not me. Because I don't do tax returns, but but this is amazing. And the big question is what happens to that 2.6 trillion? Does it come back now that the lockout now that the Band-Aid has been ripped off? And I wonder what you think, Kent. Do you think it comes back? That's, you heard it?
Yeah, I think, I don't think there's any question there was some money that was, a lot of money was trapped overseas because of the differential in statutory rates. Economists would have preferred a different system. We also not only tend to agree on a full expensing, but what's called destination-based tax, not a territorial tax. A destination-based tax was controversial, because of the border adjustment tax, and so certain importers in Arkansas and places like that did not like it. But nonetheless,
who here shop?
Yeah.
That's what I'm just saying.
But only because they were confused and shifts with supply curves, with walking along supply curves. I know they didn't take my lecture again. That was lecture 3. But in any case, that was the type of system that would have created true neutrality in terms of your location. The territorial system is not going to fully undo the it's not going to create full neutrality, because it's still going to be to your advantage to do the double Irish Dutch sandwich or anything else that will park money offshore, provided there's any type of kind of tax arbitrage. And so I think you could imagine some smaller companies that they're only parking money overseas. They have big transaction costs of doing it. For them on the margin, maybe, hey, just bring it home. Let's not hire tax attorneys. And by the way, that's what you all should become Complement your MBAs with, make real money, become tax attorneys now. But in any case, it's not worth doing the tax attorney stuff anymore for kind of if you're a smaller company.
Yeah.
But for the most part, that 2.5, 2.6 trillion, that's large companies. And then on an ongoing basis with new money, they're still going to be incented to park money over shore. What they're going to do with the existing stuff, that's a big debate.
So in the interest of time, I promised the class would have a chance to ask both of you some questions. So if anyone has any tax questions, now is the time to raise them. If you guys can, and I've been told to say that you guys need to hold the speaker button down, otherwise you won't be able to be heard. So, Rennie?
Hi, everyone. Can you speak in the topic of repatriation? I butchered that word. Can you speak on the topic of what happened in the Bush years with the 5.25%? And how that was kind of like a dud, and do you expect that to happen the same thing in terms of not a lot in terms of economic boost, and also touch a little bit about business entertainment tax and meals and things like that. I think that's kind of going away, and that'll probably affect a lot of folks here too.
Well, I can talk about the Jobs Act. It was an elective repatriation, so it was really different. And because you would elect to repatriate at what effectively was a 5.25%. But generally speaking, anything that's elective costs a lot of money because you assume as a scorer that you're only going to do it if you kind of net positive. That's why that bill was scored by the Joint Committee to lose $1.3 billion. The score for similar experiment under prior law was like $90 billion because people only brought back money to the extent that it helped them. I think we saw $250, $300 billion come back. Everyone promised to build buildings and hire, but most, the story that grabbed the day was, it was all stock repurchase. There's a lot of question about how deep the benefits of stock repatriation go down the distribution chain. I had a lot of people who said, you stock repurchase, my retirement account goes up, my permanent income hypothesis makes me go spend a lot of money. And the flaw with that is that not a lot of people have that much money in their retirement plans so it was a little bit of a dud. I think even if it wasn't, the headlines made Congress not trust that plan. People were really angry after that because we had been told a lot of things and they didn't happen. But what did happen was this other thing. But it was very, very different because it was elective. This one, you got to do it. Now, you don't have to bring it back, but you have to pay the tax. That one, you had to bring it back, but only if only to the extent that you want it. So they were really different experiments. This one, I think, will generate more real activity, although not immediately. And so maybe the timeline is going to be different. Yeah. The meals and entertainment, that's always a crushing blow to me.
Yeah. Hey, a lot of the Bush taxes, whenever you have anything that's elective, lecture 15, adverse selection. Sorry, I had to throw that in. You are going to lose money because rationally you're only going to elect to do it if it's cost saving to you, it's tax saving to you. They didn't make that mistake this time. So dealt with the adverse selection by mandatory pooling. Everybody essentially had to do it. But the Bush tax cuts, for the most part, did focus much more on the individual side. Partly it was trying to stimulate the economy and so forth. And so whenever you have a temporary change in like payroll taxes, things like that, the idea was that lower income people have a higher marginal propensity to consume because they're more likely to be borrowing constrained and so forth. And so there's a big debate how stimulating that was, but at least on the repatriation side, yeah, there was definitely a mistake that was not repeated this time.
Yeah, I have a budget model related question, and it's trying to reconcile two things. One, we're recognizing that there are big tax cuts, individually and corporate, but we're also effectively saying no economic growth from that. And I'm trying to reconcile why is that the case.
Yeah.
Intuitively, I would assume people will spend more, corporations will spend more, GDP will
right.
go up.
Yeah, no, it's a good question. This is the thing that was so puzzling for people to grasp. And in particular, suppose that, let me keep it really simple. Suppose all you did, for example, is cut the corporate tax rate. That's doing two things. That is, on the margin, stimulating some new investment, but it's also rewarding all the installed investment. And so when you reward all the existing investment, that's just a pure giveaway. That's not having the marginal effect. That's a separate effect. And so whenever you have pure inframarginal giveaways, that has to be financed with deficit dollars, that now is actually going to be negative on economic growth. This is the reason why economists actually are fascinated with expensing and not so much caring about rates. Because expensing is a different model. Expensing says, let's in fact only reward new investment. It doesn't impact the fact that old investment takes a wealth hit. The reason why is because it has to be repriced. In your macro course, maybe you learned Tobin's Q, it gets repriced because it has to remain competitive with new investment. And so expensing is actually a much cheaper way of stimulating the economy. This particular plan was much more in the giveaways because of the rate changes. The expensing only pertained to a small part. It's not all capital. And on top of that, it's temporary. It's mainly, you would have gotten this already. Now, if you had a capital asset that's more than 10 years, yeah, you get some benefit from that. But for the most part, you would have gotten this anyway. And so it was not as focused. By the way, the 2016 House plan, Paul Ryan's what called Better Way plan, that was kind of, they had some issues with it, but that was kind of the economist's dream right there. Full expensing, paid for by removing interest deductibility. That's supercharged at the margin. Destination-based tax. That gets the international thing kind of fixed. And then they made a few giveaways along the way that they didn't really need to. But that was the plan that was kind of the economist's dream. They even got the loss offsets the way economists like it as well. And so, but that was not a political plan. This is really about Kathy's remarks at the top of the show, is that there's politics and there's economic policy. And they're not highly correlated sometimes.
Do least harm is what is our thing. But can I ask a question to follow up on his? I mean, you're talking about taking a $20 trillion economy and $300 billion worth of corporate receipts each year. I was like, it's like trying to turn the Queen Elizabeth with a rowboat oar. Or am I wrong, right? I mean, this wasn't that big relative to the whole economy.
Yeah. But it's not just the corporate side, the individual side.
So it's 1.5 together, right? 1.5
so when you put it all together, and by the way, our static estimates, because of other stuff, was actually beyond 1.5. We were, closer to 1.9 on the static basis. And so the point is that here's the way to think about it. On one hand, you're actually not supercharging the economy because the incentives themselves are not really focused that much on the margin. And then, so it doesn't take much debt to undo it. And so that's the real key, is that something like full expensing, even if it created debt, if that was the only thing you were doing, that could potentially pay for itself. Because you're focusing really on new investment. It's just that when you're giving away inframarginal dollars, you really need a lot of growth. I mean, or put alternatively, you only need a little debt to just undo any benefit.
Got a question over here.
Yeah, I was curious about this tax policy that came through, or law, and related to 86. I thought 86 was created to fix corporate rates, but also they kind of got rid of a lot of loopholes.
Yeah.
And this one seems to be, if correct me wrong, they have a lot of loopholes and stuff that even regulatory and Treasury has to figure out. So we're going through and we're seeing, oh wow, we can actually do a lot of things here that they probably didn't understand. So I was kind of curious what you thought this compared to 86.
I mean, I think this is 86 on its head, is what I used to say. 86 tax reform was driven by individuals. It was an individual rate cut that drove it. At the end of 86 tax reform, corporations paid $121 billion more over 5 years, which used to be the budget window, and people paid $121 billion less. So like it was, the dynamics were completely on its head, and it wasn't till this group of, this group of policymakers learned to tie the corporate benefits to those workers, to the people who went to the polls, that this thing really started spinning. But I think this is 86 on its head. Also, we didn't simplify, anything, which is fine. Again, I'm not an overly enthusiastic fan of simplification, but this was, I
She
think.
works at a Big Four accounting firm. I'm just kidding. I'm kidding.
And you're always with me. I swear. But yeah, I do think this was like 86 tax reform upside down.
Yeah, and the process was a lot different.
Yeah.
I mean,
Yes.
86 actually had, tax lawyers involved in figuring out how they would game the system and so forth.
Well, we're involved now.
Yeah, there you go.
Can you say a little bit more about the distributional impact of the corporate side of the tax cut? You talked about the individual side. Do we have any sense of what corporations are going to do with this? Has anything come in already?
Yeah, I mean, the big one there is not so much in the corporate, it's really between what's the pass-through versus the corporate. And in particular, there's going to be a lot of opportunities. In some cases, you're actually better off if you want to do deferral strategies going corporate. But in many cases, it's the pass-throughs that got huge windfalls here. Those are correlated with being smaller business, but as pointed out earlier, you can actually have a very big pass-through entity. The big ones are, of course, the S&P 500 companies. Those are C corps. But that's where I think it's safe to say that in terms of kind of the giveaways, probably the biggest stuff was still in the pass-through side.
But we do, there is literature out there that, workers bear some percentage of the corporate rate. And the Joint Committee assumes 25% of the corporate tax is paid by workers, in form of wages, lost job opportunities, total comp changes. Not like immediately you're going to get your $4,000. But, that the Treasury, I think it's more like 18%. Other people are far more kind of forward-leaning on that. But if you look at a Joint Committee revenue distribution table, they will show you where the distribution of the corporate cut went. So it's kind of interesting. You can find that on the table.
Yeah, we make, in our static analysis, we make similar assumptions just to replicate them. Then our dynamic analysis is actually determined by the model itself.
Given that some of the corporates, multinationals, some of the rates of the GILTI levy have sunset clauses with them, like, in your opinion, do you anticipate that corporates will look at this as just kind of short-term domestic cash windfall, or will some of them just try and strategically shift their tax position to take advantage of that?
Well, they don't sunset entirely, they go up, right?
The rates like the GILTI levy.
Yeah, the GILTI, right, the deductibility goes down, so the GILTI rate goes from 10.5 to 13 and an 8.
Yeah, I think that's
over
what he's
time.
saying. Well, people
Yeah.
shift their income. Yeah.
So, but it's with us forever, I think.
Yeah.
I will say one thing here, and I am going to keep it high level, but the income shifting is one thing, but potential funding mechanisms, it could, debt versus equity or what have you, that could be the area where there's some change in planning.
So even though a lot of these individual tax cuts are temporary in law, it seems to me that politically they will be, at least a few of them will be extended. I mean, I guess it depends on who controls which House of Congress in a few years, but how many of those are likely to actually be extended beyond the 10-year budget?
What's your guess?
Yeah, I mean, that was the whole point. Is Kathy mentioned at the top, was you have this bird rule. So it wasn't a regular tax bill. They had to worry about the bird rule. So they had to have certain things sunset. You had some pay-fors in the, like ACA and so forth that paid for a lot of the corporate side. They had to sunset they had to choose which side to sunset, and they had it on the individual side. But at the same time, they're writing the legislation. They're announcing, no, these will get extended. This is just a technicality. It's always hard to play politics, but yeah, taking away something from people is always a challenge, and that's what they're banking on. From a modeling perspective, it's actually challenging because you want to model what the law actually says, because if you're actually modeling, if we're making a decision that these things will be extended, we're playing policymaker, and that's not our job. Our job is to say, what is the actual model. But at the same time, as you learn in your finance courses, people make investment decisions based on expectations. And so the way we model it to be the most optimistic in terms of generating growth was to say people assume that these things will be extended forever. And then when they're not extended, that comes as a sudden surprise. And later on. And that gives you kind of the outer envelope of the economic growth. And so even if there are all those expectations, well, I don't think there's going to be a lot of juice economically from that. Otherwise, what's my Bayesian priors in terms of whether these things will be extended? That one's hard. If this was on the corporate side, we could actually look at trading markets to figure out the probabilities. Like, the Alibaba trade was how people were trying to figure out if this tax reform would go through, because there was a tax arbitrage between Alibaba stock and then Verizon Yahoo stock. Between Yahoo and Alibaba, most of value of Yahoo is Alibaba stock, but it's a different tax treatment than Alibaba. So you can back out what the probabilities of this thing going through was. And but on the individual side, much harder to do that because people aren't, I'm not shorting your taxable income and things like that.
Yeah, but you should look at the Bush tax cuts and make your bet. Right? How long did it take the Bush tax cuts to be permanently settled? It was like this lurching, hideous political hostage-taking event every year for, how long was that? Like years, 2, 3, 5 years? And I would predict that's probably our best example, right? It's probably our best signal on what we can expect. Mostly the attention will be on the top rate. Yeah, I would say.
And I actually think this worked. The Republicans were going to like this because the endowment effect. In particular, people get used to something, they adjust to it, and they expect it. And so there's always these hammers that both parties want. So in the old days, it was indexing of Social Security benefits. Should you increase the Social Security benefits? That was the hammer Democrats had. And so the Republicans finally agreed to automatic indexing the wages, so that took away the Democrat hammer. So now the Republicans have a hammer kind of in the future. There are going to be guys who will extend and so forth. And because of this endowment effect, they're hoping that, it'll be an effective hammer for them.
So we have actually run out of time, but I'd just hope everyone can thank Kent and Kathy for joining us today.